Good afternoon, everyone, and welcome to the latest in our series of the long and the short of it webinar from Admiral Markets UK with myself, Darren Sinden, and my colleague Clive Lambert. For those of you who haven't joined us before, I look at the markets with a fundamental eye, whilst Clive comes at things from a technical perspective. Before we get going today, just one or two bits of housekeeping to take care of, starting with the all-important risk disclaimer. Trading FX and CFDs using leverage can of course result in a loss of all of your deposits. Trading losses can exceed all of your deposits. So if you're in any doubt about the suitability of margin trading for yourself, please take some advice, and my colleague Michał Onachov, who will be speaking at the end of the seminar, will be happy to try and answer any questions you may have. So the subject for today's webinar is living with a low oil price, and we'll try and pick out some winners and losers from what has been a fundamental change in one of the key components of global markets. After a quiet holiday period, I think we've probably all been quite surprised to come back to 2015 and start with such a bang. In this webinar, I think we're going to look at one of the key defining events of 2014, and to my mind perhaps one of the defining events of the last 50 years, and that event looks very likely to shape 2015 as well, and may even go beyond that. So without further ado, the first slide really is just a recap from what we saw in 2014 in those last, predominantly in the last quarter, but really I suppose across the second half. And it wasn't just oil that has sold off dramatically. If we look here at the table in blue on the left hand side, we can see the whole energy complex has sold off dramatically. Yes, IPE, these prices as of the closing prices the last day of trading in 2014, but IPE Brent yes, sold off by 47.3%. NYMEX crude is down 45.9% on 2014. But if we look further down, we can see gas oil, heating oil, natural gas all sharply lower, and even coal finished the year down 12.8%. So substantial falls across the board, and if we can see here from the chart on the right, it was steep, sharp, and very, very messy. That chart there showing you Brent crude and WTI West Texas Intermediate crude. So really probably the first place to start if we're going to examine what's happening to oil and what's going to happen going forward is probably to look at the historical background to the situation that led up to the momentous events at the end of November. And we need to really look back to the early 1960s, in fact 1960 itself, to the spring of 1960, and to Iraq, when OPEC was formed. 5 members originally joined in 1960, and that was expanded to 15, another 9 members joining in 1961. People were aware, I suppose, or some were aware of OPEC's existence at that point, but it wasn't until the early 70s that the cartel came to the world's attention, and the oil-producing cartel, its members flexed their muscles in the early 70s, dramatically raising the price of oil. And for any of you that are old enough to remember, when we were living in the UK at the time, one of the reasons that we experienced power cuts on a weekly basis and moved to things like a 3-day week. We're hard to credit that in today's 24/7 always-on economy, but in living memory that those things were happening. Sensitivity of oil process or oil prices to geopolitics. Since those sharp price hikes of the early and mid 1970s, oil has become increasingly sensitive to geopolitics and to I suppose to some extent global foreign policy as well. Price sensitivity and that sensitivity to geopolitics was supported by US demand, and as I say, their foreign policy over the last 40 years. And you don't have to be a rocket scientist to work that out. Just think of the number of incursions that the US has made into the Middle East, either formally or covertly. Obviously, 2 Gulf wars against Iraq would be the pinnacle of that, and the Middle East has remained a hotbed of political insecurity, really, over the last almost the last 60 years. We also saw some other important developments over the last 10 to 15 years. Economic growth in China and India, as particularly in China's case, it moved away from this idea of a centralized command economy and more to an economy that was prepared to look at free market and free enterprise, obviously still with the guiding hand of the Communist Party behind it. And India started to industrialize more rapidly. Other emerging economies obviously boosted demand. I'm thinking here perhaps the industrialization of places like Brazil and the tiger economies of Southeast Asia. Now that growth in emerging economies not only boosted demand for oil, but would also create new supply. That would be a factor going forward, as we shall see. So and following on from that really not all of those new suppliers decided to join OPEC, and we saw the emergence of substantial non-OPEC related production, and as one of the biggest proponents there, Russia. And again, as we'll see, that turned out to be a double-edged sword for the Russian economy. The other significant development, I think, and this is one that really sticks in my mind, is since the new millennium, is what I would call the financialization of oil trading. Oil trading used to be the preserve, really, of specialists, of, if you like, trade users, and of the likes of BP and Shell, who wanted to hedge their exposure, hedge their production. But certainly from my experience from around 2002, there was a lot more interest in oil trading, and I worked in those days in a financial futures brokerage. Oil trading was certainly the buzzword, and clients were very interested in trading that. And just as they were, that interest was picking up, it became much more accessible as online trading became available to a whole new breed and a whole new generation of customers. The graphic on the right shows just how important oil is to the members of OPEC, principal among them Saudi Arabia. The chart is a heat map, and it shows exports by a percentage and of the total, and of the dollar value of the total. 76% of Saudi Arabia's exports are made up of petroleum, oils and crude. And as we can see, some of the smaller boxes on the right hand side, alcohol, ethanol and other derivative products make up another chunk of that. So oil has been phenomenally important to the OPEC member states, and I don't think we can overstress that. And as we'll see later, that fact that the importance of oil is obviously going to make a massive difference to their economies going forward. So what were some of the causes of the oil price collapse? Well, I think that's something that we could debate far longer than the time that we have available to us today would allow. And there are many theories, but I think in essence what we have seen is a sea change in the dynamics of supply and demand in world energy markets. Global demand has been falling at the same time as supplies and reserves of oil and other oil-related products have been building. And the International Energy Authority's current estimate of world oil demand, which was published in Q3 2014, was 800,000 barrels per day, or 50% below the levels the organisation had been estimating as recently as June 2013. So within just over a year, global demand growth had been slashed by 50% by one of the world's leading energy authorities. And to just sort of re-emphasize this point about supply building at the same time as demand was falling, there's a chart on the right hand side there that plots US crude inventories, and these have been rising across 2014 even as the US economy was strengthening. One might have expected to see a growing US economy sucking in more oil and draining the inventories, but quite to the contrary, inventories have risen and look set to continue to rise across 2015 as well. Sorry, let's just go back a slide. Getting a bit carried away there. So the key date, November the 27th. The place, Vienna. OPEC's annual meeting. OPEC members effectively threw in the towel as far as price management was concerned. Saudi Arabia, pretty much the elephant in the room there, had declined to cut its production, and other member states had little choice but to fall in line. Historically, production cuts had been a way for OPEC to try and maintain an oil price, at least within a range, but they've basically given up the ghost, and many people saw that as a disaster. Market assumptions about supply management and the OPEC's decades of mystique was shattered in one blow. And some commentators are suggesting that OPEC had effectively thrown in the towel. And I think when we see what's happened to the price of late, that's probably a fair judgment. Speculative longs in oil panicked out. We talked about the financialization of oil trading. Lots of speculative positions in oil. Those on the long side were skittled out by that news. They either closed themselves out because of the ferocity of the move, or it was done for them on a margin call basis, and plenty of stops were hit on the way down. One of the other interesting factors to consider, and I think we could probably have a webinar on this in its own right, is that just a month before, at the end of October, US quantitative easing had ended, and the graphic to the right-hand side just shows you what oil had done over the 3 rounds of QE and Operation Twist in the US, and the big blue arrow there very kindly highlights the end of QE3 and the sharp sell-off in oil thereafter. Could be a coincidence, but it also could be, a factor, and only history will tell. But it could be that QE had been supporting oil prices as it had been supporting many other markets as well. So if we turn now to the immediate effects that we felt just after that OPEC announcement. It's also quite fateful, of course, that the OPEC meeting was scheduled to fall on Thanksgiving Day. US markets were closed. Most people were away the following day for a long weekend, and it wasn't really until the Monday that the full ramifications of OPEC's decision were felt. It was felt first by a run on the Russian ruble. The falls had become so sharp that the currency became untradeable. The Bank of Russia had little choice but to hike rates, and they hiked them initially by 1%, and then a few days later by a massive 6.5% to 17% in an attempt to stabilise the situation. They've also forced big Russian corporates to sell any of their foreign exchange holdings and repatriate rubles. For the moment, the panic seems to have subsided, but who's to say that it won't start again? But it wasn't just the Russian currency and Russian equities that felt the pain. There was a sharp sell-off in exploration and production stocks and oil service stocks across both Europe and the USA. And to exemplify that, the UK oil services sector finished 2014 down 27.5%, versus a modest gain of 0.9% for the FTSE 250 index. So just to give you a comparison there, sharply lower those stocks against what's seen as a benchmark index for many of them. The capital expenditure, or CapEx, of major oil companies was already slowing in Q3 2014 as the oil price began to weaken. It was down by 7% over the prior period in June 13. And that trend is likely to continue. And according to research from the IMF Direct and Rystad Energy, that could continue out to 2017, and I think perhaps beyond into perhaps 2020. The graphic here on the right hand side just really wanted to show you how sharp those moves were. If you haven't seen those sort of plotted before, the ruble is the line in green, ruble against the dollar. The higher that green line goes, the weaker the ruble. The oil service sector in the UK is plotted in blue, and you can see that's moving very sharply from right to left. It does try and rally in midway through December, but has begun to turn lower once more as oil prices have weakened yet again in the new year. So it's worth perhaps taking just a quick look at what the situation was between producers and consumers, and this table here endeavours to do that. And the phrase I've used here is a very fragile equilibrium. as I said, it was upset by slowing growth in global demand. Um, and I won't spend too much time on this. Perhaps you can have a look at it, a bit later on. But you'll see here production in thousands of barrels per day. The big producers here on the left-hand side, the large consumers on the right-hand side. I think it's quite interesting to note that, as we'll see later, the US features towards the top of both lists. China is also high up on the list of producers and consumers, as is Brazil. So. And of course, global demand slowing, particularly in China and in the likes of Brazil, and that tells its own story. So that fragile equilibrium was easily upset, and the results are all too apparent. So what are the longer term effects likely to be as far as the world economy is concerned, as far as the crude oil price is concerned? Well, I think this is quite hard to quantify. We've seen the initial fallout. We know now the kind of price levels that we're talking about, and I think Clive will show us later in his piece on the technicals in the market that this is not an unprecedented event. It might feel like that to many of us, but we have seen something like this before. What we'll need to see as far as the total macro outlook is what will happen now to global GDP growth. It's been waning over the last year. Will a lower oil price see a return to growth? And if it does, will it be sustainable? And I think to gauge that, we need to look to places like China, to Japan, where obviously the government is conducting the world's largest monetary policy experiment, quantitative easing experiment, but they're trying very hard to reflate the economy. Japan, of course, has to import a tremendous amount of energy products. And India, an economy that's also got a new government who again are trying to bring back near double-digit GDP growth for the country. Those three big powerhouses, if you will, of economic growth, China, Japan, India, will need to look perhaps in 3 and 6 months' time to see if this oil price is sustaining those economies, is helping them, and if we can tell whether the growth itself or an improvement in growth is sustainable. The next sort of thing that's hard to quantify is the marginal cost of US shale production. The growth of supply of shale oil and gas from the US has been really one of the most remarkable stories over the last 2 or 3 years, and it's that increase in supply that some would suggest it prompted the Saudis to refuse to cut output to try and drive down the price of oil, perhaps with a view, the cynics would suggest, of trying to drive some of the US oil, shale and gas oil producers out of business. Marginal cost of US shale gas is a hard thing to pin down. In the graphic below, again from the Rystad Energy and IMF Direct blog, the suggested price is around $62 per barrel, but by 2020 or out to 2020. But I have certainly seen stats that suggest that certain of the production areas can produce oil profitably around $35 to $40 a barrel, which is obviously a big drop from 62. And again, I think we'll need to wait a couple of quarters at least to see, what happens as far as marginal costings for US shale production. Will some of these shale producers cease to produce? Will the supply tighten, or will they carry on drilling new wells and expanding production? And there are reasons to think that could happen, as we'll come to later. Another interesting factor is that US GDP growth was revised up sharply. I think you remember before Christmas, a revision to up to 5%. Now that wouldn't necessarily be expected to carry on quarter on quarter, but it will be interesting to see if this lower oil price and a move towards energy self-sufficiency can sustain growth in the US economy at those kind of rates. The other interesting factor which will weigh on demand generally, and global growth generally, spending plans in oil-producing economies are now, of course, dramatically under pressure, and recession and social unrest looms large for some. You might remember back into what we now know as the Arab Spring, particularly in the Middle East. Angry young populations were placated with large spending plans and promises of social benefits. I think many of those plans were probably made on the premise of higher oil prices, and it will be interesting to see now if they can be met, and of course what the consequences are if they can't. So what does all this mean for traders? What can we take away from this, and what can we try and what knowledge can we try and use to influence our trading decisions and to try and make them better and more profitable? Well, who are the likely losers from this sharp fall in oil and related products, the prices thereof? Well, Russia, we've already touched on, but just to sort of quantify that, 63% of Russia's exports were in petroleum products as of the end of 2012. The data is from 2012 because these things are only done on a biannual basis. This is the latest sets of figures we have for this, but I'm sure they haven't deviated too far from that, and if anything, they'd probably be slightly larger than they were in 2012. Of course, the other losers are the other principal exporters of crude and crude products. We've already touched on Saudi Arabia, but you can see there Iraq, Qatar, and the UAE, as well as Kuwait, all making up that top left-hand corner, or left-hand side, if you will, of the heat map there of largest producers. Of course, it's not confined to the Middle East and Russia. Norway is a substantial producer of oil and gas. They will be cushioned to some extent from the worst effects of a crashing oil price, because they've been sensible in building up the world's largest sovereign wealth fund. I believe I'm right in saying that they've squirreled away around $175,000 for every person in the country, quite a substantial buffer that they can call on if they need to bump up their income or subsidise public spending in what is, after all, a high benefit, high welfare, high tax economy. As far as Russia's concerned, I think the writing really is on the wall there. Inflation and recession seem inevitable there. I think a weak oil price is likely to drive them closer to China. We've already seen some ruble and yuan currency swaps in place, and I think perhaps bigger lines will follow. But I don't think even that can really spare Russia from the worst of the downturn. It's almost inevitable that we'll see a protracted recession there. I think Mr. Putin's hands are tied as far as that's concerned. I think that might well suit the policymakers in Washington, D.C. So low prices may hit high break-even producers hard and fast. We saw that pan out immediately in Russia. And I think perhaps we'll now see that filter through into Saudi Arabia and Iraq and also Iran. It's also very interesting to note that Saudi Arabia and Iraq have a break-even costs of $100 plus per barrel if they want to maintain their current levels of spending and the current budget projections for this country. But Iran has a very high break-even price as well, north of 120, and $120 a barrel. And I wonder how long that's sustainable. And it does occur to me that perhaps that may force their hand in the nuclear talks, which have been off and on over the last 2 or 3 years. Perhaps they'll now have to come to the table with a bit more of a pragmatic approach as a lower oil price begins to bite hard. And if we've been talking about discrepancies, we're $60 to $70 away at current levels from that break-even price that Iran needs to see. So who are the winners in this titanic struggle? Well, not surprisingly, the winners are the principal importers of crude oil and related products. And here in the heat map, we can see that China, 15% of all its imports are made up by crude oil and crude oil products. Japan, as we already touched on, a massive importer of crude oil and crude oil products because they don't have any natural resources to speak of their own. And of course, following the terrible tsunami and nuclear accident at Fukushima, they've turned off the nuclear power plants, which of course were the principal generators of energy for Japanese industry. Korea is also a substantial importer of crude oil, and we'll touch on that in due course. But Europe, on the face of it, should also benefit from lower oil prices. However, structural issues in the energy markets within Europe, such as subsidies and taxes on energy in Germany, making German energy amongst the dearest in the world, and the French economy's reliance on nuclear energy, which generates 70% of France's electricity, are genuine barriers to that low oil price filtering through into the underlying economies. In Japan, they consume some 4.7 million barrels of oil per day, nearly all of which is imported, as I've said. And in 2012, they spent $240 billion in total in energy imports. Now, the low oil price may help offset the pain felt by non-exporters in Japan, non-exporting companies in Japan, which has been caused by the weak yen policy. So a 50% fall in oil, which is what we've seen, probably offsets, the 50, to some extent anyway, the 50% fall we've seen in the yen against the dollar, and at least where's probably Japanese importers, non-exporting companies are playing perhaps with a slightly more level playing field now than they were back in the autumn of last year. One of the biggest beneficiaries of this weak oil price is actually going to be the USA. And we've already seen that the US is a significant crude oil producer, and in fact, in 2014, it was the world's third largest crude oil producer, as we can see from the graphic here on the left-hand side, sourced from the Oil and Gas Journal and Citigroup Research. The key thing here, though, is how small the oil and gas industry is as far as GDP is concerned, and energy and construction GDP in particular. It makes up just around 3%, I believe, of the total GDP of the US. So it's a very small figure in comparison to the other large producers here. Obviously, as you'd expect, Kuwait, Brunei, Saudi Arabia, very dependent on oil. Norway, to some extent, but obviously with other industries. Russia as well with other exports. China, naturally, a very big export-led economy. The Euro area is relatively small because apart from Norway, there isn't really any oil and gas in Europe, leaving the UK out of the mix. But the US is the best placed economy. And who will be the beneficiary of that positioning of the US? Well, the US economy as a whole will receive a modest overall net boost from lower oil prices, but it is US consumers and households that are going to be the real winners, and in fact they already are. They benefit directly and immediately through lower petrol prices, lower energy prices, and I've seen estimates that suggest households could be up to $1,250 per annum better off as a result of current oil prices. Obviously, the lower oil goes, the higher that figure is likely to rise to, and that genuinely means that we're likely to see higher disposable incomes in the US throughout 2015 and beyond, which will be good news for consumer-driven stocks in the States. And whether it drives valuations higher or is just a mechanism by which they can be supported remains to be seen, but certainly an area that I will be paying close attention to over the next couple of quarters. So who else and where else might we find a winner as a result of weak oil and a strong dollar? Well, could those two factors, a strong dollar and a weak oil price, produce a boost for Korean equities and the Korean economy in 2015? Looking back to our table, Korea imported around $150 billion worth of petroleum products in 2012. Of course, the price, as I've already said, is 50% cheaper than it was at the height of, well, in fact, if we look back to the very top of oil, probably about 30%, probably 60-70% cheaper, but certainly 50% in recent times. And it's also very interesting to note that Korean exports, total exports, make up 54% of GDP. So a strong dollar with a depreciating won. The won has basically matched the yen, as we might expect it to, in its weakness against the dollar. So Korean imports looking very cheap to US buyers, if you will, And of course, if oil has fallen by 50%, then the Korea's bill for paying for oil is offset by, which obviously with rise of the weakening yen, is offset by that fall in oil prices. So I suspect that with GDP tagged at around 3.5% for 2015. Admittedly, that's been slightly trimmed since the last forecast for 2014, which were around 3.7%. But steady 3.5% growth. Many of us, or certainly all of those of you in the eurozone, I should say, would like to see that. Here in the UK, we're probably growing around 3% at the moment, although there's some debate about that. But certainly, many world economies would like to see 3.5%. GDP growth, and one of their biggest customers' currencies increasing, one of their biggest input costs falling. So to wrap up, what's the outlook? Well, there's no obvious reason for an early turnaround in prices, as far as I can see, from a macro or a fundamental point of view. We must form a floor at some stage, but I mean, I did see perhaps a wild headline, but said on Market Watch today, some traders are betting on $20 a barrel. Not impossible, because when I started in the futures markets at Refco back in 2002, oil had moved up from $20 to $25 a barrel, and people were aghast at that price rise. And I'm sure, as Clive's charts will show us later, that those prices don't look too out of kilter from the current levels. The USA is better positioned than almost every other economy to ride out the storm and achieve its foreign policy goals without the need for military force. And I think that's one of the most important things about this whole situation. That America can apply, or is applying, pressure to allies and foes in the Middle East through the weak oil price and the strong dollar. It's able to bring enormous pressure to bear on Russia without having to do anything particularly. Just sit back and watch the dollar appreciate, watch the oil price fall. That really pressurizes Mr. Putin far more so than any of the sanctions that have been introduced by the US and Russia in response to the Ukraine. And the win-win for US presidents and US voters is there's no need to put boots on the ground or aeroplanes in the skies overseas. This is all being done by the globalization of the markets. And OPEC members then and other producers is the real takeaway: to feel intense economic pain and face more social unrest if the current spending plans that they've outlined have to be cut out. Many of these large oil producing countries, particularly in the Middle East, have a very young population, a very large proportion of which is male and often unemployed, often by choice, but they've got a lot of time on their hands. And they, as we saw in the Arab Spring, they can rise up collectively and demand change very quickly. So I should think there are, across North Africa, across the Middle East, there are probably some sweaty palms amongst the sheikhs and governments in charge of those areas. And I'm sure they'll have the slide rule out and the calculators out over their budgetary figures and be wondering how long they can suffer the price falls. In fact, what they've all created, OPEC and the other producing countries, and I guess the savvy consumers who, of course, let's not forget, have been ever since oil prices went north of $100, have been making their economies much more efficient, moving towards alternative energies, making cars, heating, consumer goods much more energy efficient. And we're not going to stop now, of course. So global oil demand is likely to fall anyway, regardless of what happens in terms of global demand. Yes, we could see a pickup from China and India as they continue to industrialize and more of the population become part of the modern market economy. But as far as the West is concerned, demand is on the wane. And I think for the Middle East, a few chickens are going to come home to roost. Anyway, look, I've run over time, so I should pass over now to my colleague Clive Lambert, who will take us through the technical picture for oil and the oil outlook. So thank you very much, and look forward to speaking to you again in the near future. Over to you, Clive.
Technical thoughts on the oil price et al. I think you might still have me in the background there. Is there any way of trying to get rid of that? No, maybe not. Okay. All right, so let's have a look what we think about oil prices with respect to the charts. This is a monthly chart, and it shows that big drop that we've seen in recent months. So what does that? That is obviously pretty significant, and we, goodness me, this is really driving me mad. I can't actually see what I want to see. Okay, I'm just going to carry on assuming that you can actually see what's on my screen. We dropped from 112.80 back in July down to sort of $51 last trade in this particular thing. But if you look back at this monthly chart that I'm showing on the screen here, you can see that actually we had a big drop, a big move in oil. Earlier on in the millennium, I suppose we call it now, 2004, we were down at $36, and then, and this is a log scale chart. We got through to 2007, 2008, and suddenly we were up here at 147. And I remember the headlines at the time. Everyone was saying that oil was going to go to $200 and $250, and there was all sorts of crazy headlines like that. And then suddenly, it absolutely fell out of bed. Actually, on this monthly chart, we sold off right down there to $36, a massive, massive sell-off. The ship steadied very nicely from there, and and then we saw another rally, and we got used to prices around $70 here, and then up in above $100 throughout 2010, 11, 12, 13. A long time spent at those prices, but during that whole time we were seeing a tightening of the volatility on this particular chart. You can see that the market was consolidating basically, and quite often after a consolidation you see a you see a break and you see a move, and that's exactly what we've seen in the last 6 months, 6 to 12 months in Brent crude. Now, it was the end of November when prices on Brent broke below $85 that I turn around to all my clients, anybody who'd listen, and say, right, we are going lower still. And no one was really talking about oil at this point, but actually using a technical methodology, very basic sort of textbook stuff this is. You are looking at this consolidation period right here as being halfway through the move, if you like. Now, if you know where halfway is on a move, then you are able to work out where it may end. And actually what we had here was we started off this move at 115, and this took us down to $85, up to 88 consolidation, broke 85 around here, and it was at that point I said to clients we could go to $53 for Brent crude, and that is exactly what we have actually since then achieved. We have achieved that price of $53, and the market is now for me getting to extremely interesting levels. I think that we may be getting close to a bottom. Why am I thinking that? Well, I'm thinking that because I just think that I almost think there's too many people talking about it now, to be honest. There's no, and also because we've reached that measured move target. So the other thing that I would say about this actually is there's an indicator called the RSI, the Relative Strength Index, and that is oversold now. That is that bounces between, well, it can get down to 0 or get up to 100, and it's a momentum study. If you see a reading below 25, that suggests the suggestion is the market is oversold. We have hit oversold levels on that particular study on the daily chart, the weekly chart, and we'll go back to our previous slide, the monthly chart as well. That's showing a reading of 20. Every single time frame is showing oversold on the RSI. That's pretty unheard of, actually. Now, the RSI being oversold is not a buy signal in itself. The buy signal you get from RSI is when it comes out of it, it starts to move higher and comes out of oversold and moves back above 25. That's your basic buy signal for the RSI indicator. So we're not getting a buy signal from that yet. We have got a short-term downtrend line that I've thrown on the daily chart, and I'm going to keep an eye on that as we go forward over the coming days. I am trying to, I've got a couple of levels above that I'm keeping an eye on with respect to telling me whether the market may have bottomed out for the time being. And so I'm keeping an eye on that, sticking with the trend, because we are, I do try and follow the trend and stay with moves, with lower moves, but I am starting to feel that the market may be getting near a bottom. And here's another reason why I feel that. If you go to a log scale monthly chart, you can draw a couple of lines. Neither of them are absolutely prime examples, but they both show that we have come back to a sort of the long-term rising trend lines, if you like. Again, something that may suggest that this 50 area is going to be somewhere where we can find some support. So we shall see on that front whether and I actually put on Twitter yesterday, I stuck out on Twitter that I don't think we are going to see Brent crude sub $40. So we shall see if that particular prediction, if you like, of mine will how that will unfold. So. I mean, one other thing to point out as well is that the dollar strength has been a contributor to this. There is, again, a monthly chart that's showing the dollar index, so that's the dollar against the trade-weighted basket, and shows you that we have broken a considerable consolidation period that was the last getting on for 10 years now. That's been, if we're going out to this sort of time frame, 10 years that we've been consolidating in this sort of in this triangle, symmetrical triangle type of arrangement. And now, in last year we broke above top of that trend line. This downsloping line here was at 85 when we broke. We're now trading at 91, 92, and we are approaching this resistance here from these two highs back in 03, 04. So we're getting to some interesting levels on the monthly chart in the dollar index as well. Incidentally, 90 was a big level when we did take that out. That was that high there, and it was the 38.2 retrace of this entire move. So 90 was a big level, and that was taken out. Dollar CAD, the Canadian dollar, has a pretty strong correlation with oil, as we've discussed in previous webinars. And, we can see, well, inverse, if you like, that this particular chart shows US dollar, Canadian dollar. So if oil's going down, then this one is usually going up, and you can see that correlation is fitting quite well. 117.80 is a big level for dollar CAD. Again, I'm looking at monthly charts, and we are now sitting at that big resistance level at 117.80. So there's another chart that the trend is higher, but we are hitting some resistance, and I think that the main crux of everything I'm trying to say is just to urge some caution, getting too carried away with this idea that oil can go to $30 or $20. Just slow down, sort of thing. The Aussie dollar is another commodity-based currency, if you like. It's quite often attributed to be something that closely follows gold. But you can see we've had a similar kind of consolidation during October in that one as well. Early November saw the top line of that rising wedge retested, and we failed there. This was a clear sell signal and gave us a measured move target of 79 Aussie dollars to the US dollar. We have got as low as 80.25, 80.30, I think it was the recent low in that one, and tried to rally today. I'm just going to see exactly where that one is now. If we'd seen a close above 81.30 tonight, 81.35, 81.40 in that one tonight, then I would have actually, we would have posted something called a Morning Star. Pretty significant candlestick reversal pattern. It doesn't look that way at the moment. We did try and get up to that level and sort of fell over a little bit. So that's going to be an interesting one to watch with respect to where tonight's closes on the daily candle. That might give us some respite, see us back up to 82, even somewhere like that. Just looking at another one of my charts. Yeah, 82, 82.50 would be a target if we could achieve that, but it doesn't look like we are at the moment. It looks like that trend's staying intact, lower highs and lower lows indicating further weakness there. And as I say, the measured move target is 79 for that particular pair. Pair or cross, Darren will tell me off. I always get that one wrong. So that's my little sort of quick, swift run through the charts. Hopefully there's been some, there's been some wisdom in there somewhere, and thanks again to Darren for everything, and I shall catch you all again next time. Happy New Year, and thank you very much for listening. Cheers.
Very much to Darren, and thanks very much to Clive. Now I will take the floor if nobody objects. My name is Mikhail Onahov. It's quite difficult. I do have some other moments. Okay, here's my presentation now. There we are. I hope that we can all see it just fine. Now I have the confirmation that we in fact can. I hope all of you can hear me okay, and I'm sure all of you are experienced webinar participants and you know the drill. After an educational presentation, you get to hear some information on a forex broker. So since Admiral Markets was the host of this presentation, it's only fair that we get to listen to something about Admiral Markets UK. Now, year 1215 is upon us. Happy New Year, by the way. And all of you, my dear friends, decided that some things need changing. Changes were a part of your New Year resolution, and since we're talking about changes, why wouldn't you have a look at the new forex broker, especially since Admiral Markets has now launched Trading 2.0 program. Now, when it comes to choosing a broker, there are three key things that you want to look at: regulation, platform, and execution type on offer. Admiral Markets UK is in fact FCA regulated. We give our traders access to MT4, MT5 and MT4 Supreme Edition. There is no dealing desk, which means no requotes at all. Now, the account in question is called Admiral Markets, our flagship product, and we were so proud of this account we actually named it out after ourselves. Fantastic account. Leverage is 1 to 500. Average spread is only 0.8. No dealing desk, no requotes. I can't stress this enough. Just look at some of the instruments and the typical spread at a typical time. Now, do I really have to say more than that? Well, if I do have, then please email me at mo@admiralmarkets.co.uk and I'll be very happy to answer all of your questions. Now, this is my name, difficult to pronounce, email is easy. So if you have any questions or would like to become a client of admiralmarkets.co.uk, please send me an email or give me a call. Happy New Year, guys. I hope you enjoy the webinar session and see you next time. Thank you very much. Have a nice evening. Bye-bye.